Jonathan Garner, Chief Asian Equity Strategist. He represents Morgan Stanley, joins us live from Hong Kong. Jonathan, fantastic to have you back on ET Now. Thank you for joining us. What is your take? Do you think the Fed has sent a strong signal across that in the near term they will not tighten and they will not pull their plug out?
I think what Chairman Bernanke was trying to do was to get across what we call here the separation principle, i.e. tapering bond purchases, which is going to happen, is a separate matter from the first rate hike. And I think the market had got ahead of itself in relation to expectations for the rate hike path. If you go back to a week ago, the December 2015 Fed funds future was indicating an expectation that Fed funds would be 1.25% by the end of 2015. And that had gone up from around about 40 basis points Fed fund futures at the beginning of May. So there'd been a dramatic repricing of rate hike expectations. I think what he was trying to do was to push back on that a bit. And as you've already mentioned on your show, the consequence has been quite notable in relation to dollar weakness, gold strength. The bids come back into the long end of the bond curve in the US. And I do think that that gives us some hope for a tactical bounce in Asia ex-Japan and EM equities, including India. But I do think there are some significant longer-term fundamental pressures that will remain on the asset class. So I don't think we're going to be off to the races with a strong V-shaped recovery in our markets.
Jonathan, so what's the sense in terms of how equities may behave? I mean, we've seen the US equities hold up pretty well. Do you see strength or do you see consolidation in the near term?
I think strategically we prefer Japan and the US globally. And in relation to Asia ex-Japan and EM, we've been quite cautious. As I just mentioned, the fundamental issues are the following. We have the reappearance of Japan as a major competitor to some of the industrialized countries in Asia. We have a backup in US rates that will still be in place, which is threatening those countries that have external funding needs, and that does include India in that regard. And we've also have, of course, China deleveraging. China has chosen this moment at the start of a new government to attempt to delever its banking system, and that's producing downward momentum there, and that in turn is affecting industrial commodities prices. So these fundamental issues are going to be with us. They're still going to be with us. Just tactically, some of the pressure, which was really extreme in June, has come off our markets, I think, overnight.
Jonathan, what really shook the world 3 weeks ago was the FOMC meeting, and just about everyone on the street was convinced that liquidity will only get scarce going forward. Do you think that big fear has got diluted, or that big fear still exists in the system?
I think it's being diluted a bit overnight, probably because the market overreacted, not so much to actually the FOMC meeting, but more the press conference afterwards. And again, it's interesting that it's in Q&A overnight that Chairman Bernanke's used the opportunity to push back on, I guess, some of the more hawkish interpretations of what was said 3 weeks or so ago. So there's obviously a change in US monetary policy. It is a big deal. We've been in a very, very easy period for a very long time. But again, I come back to what I said earlier around this separation principle. The tapering of bond purchases is not the same thing as a rate hike.
Jonathan, so do you think in the immediate term US bond yields has topped out along with the dollar index?
When we look at our view for the US 10-year, as we go into early next year, we'd expect them to be slightly higher than they are now. But tactically, it would again seem that particularly the further out on the US bond curve you go, the more likelihood it is that yields stabilize from here.
And Jonathan, do you think the long dollar trade right now is extremely crowded, and after last night's comment from Mr. Bernanke, we could see a big unwinding in the long dollar trade and the short emerging market trade?
Again, fundamentally, EM is quite pressured here. A number of countries have built up quite large external balances. Some of them have been having banking systems that have grown credit too fast relative to nominal GDP growth. The US is recovering economically. That's why we're in this whole debate. And we upgraded our US GDP forecast 6 weeks ago and downgraded many of our EM numbers. So what you're talking here is a tactical thing rather than the longer run strategic position. And so, again, we would be preferring US and Japan equities here. Still quite cautious strategically on Asia ex-Japan and EM, but we'll get a tactical bounce.
Jonathan, good chatting with you. Appreciate you taking the time out and speaking with us today on ET Now.